Welcome, everyone, to the Mortgage Heroes Weekly Podcast, where we talk about how you can win in real estate and mortgage. Each week, we have a new topic to discuss and dig into. We share opinion, perspective, advice, and insight that helps to bring forward the most important topics of the market to the table. I'm Andy Cruz here in Business Development, and today I have with me
Will Flores of Mortgage Heroes, your VA specialist.
And
Brian Landeros, otherwise known as Brian Lends Money on Instagram.
Brian Lends Money on Instagram. So last week, we talked about the Federal Reserve's most recent rate hike, and we broke down what Jerome Powell said and didn't say during the press conference following their announcement. So for saying so little, they also kind of said a lot. So if you missed that episode, you can go back one episode and take a look at that one. But a lot has already changed since then, and that is unfortunately what we have to talk about today. So the first thing we're going to put on the table today, guys, is the rate environment. What the heck has happened since the Fed's press conference? Because my reaction is, what the heck?
What the heck?
My reaction is,
what
the Fed?
What the Fed?
What the Fed?
Yeah, what the F? What the Fed?
And honestly, I feel like this is something that happens every time the Fed goes up to speak, and it's the market takes the news well. The rates do very well for that day, maybe into the following day, and then they completely take back everything that they gained, you know? And it's been an ongoing story. I've seen it so many times, and I'm like, okay, I'm going to lock my loan today because I don't know what's going to happen tomorrow. Right. And we saw it happen just like you said on Monday Mortgage Minute. We gained some, but throughout the week, Friday, we gained all that back. The market gave it all back, gave it right back, and then some into opening on Monday. And now we're basically, a little bit higher than we sat before the Fed meeting.
Right.
So welcome to the Fed, guys. Welcome to another Fed of Mortgages rates.
Well, this is how I feel, you guys. I feel like a little kid. I will no longer tease little ones. When you have a candy, you're like, hey, you want a candy?
Yeah.
You know what I mean? And they're all excited, and then you don't give it to them. Oh, you know what I mean? That's how I felt what the Fed treated us.
Yeah.
They gave us a little bit of the taste of the candy. When they announced the 25 basis points increase, it was like, dang, rates got better.
Oh my God, 4%.
And all of a sudden, the next day, it lost it more than half, and then the following day we lost more.
Yeah,
right.
One of the things that
I will no longer tease a kid.
Yeah, no, and one of the things is that it's on like lagging information. So everybody the following week, come Monday, was like, "Hey, rates are down. Rates are down." Right. Yeah. And then we're over here like
no, they're not.
No, they didn't. Like, no, they didn't. Yeah. On media, yes, but on paper, we know exactly what's going down. Yeah,
exactly.
I think that points to a key thing that I know we know and we talk about, but I really do want people to understand, like, every day that the open market is open, rates can fluctuate up or down or neutral, what we call sideways.
Oh, yeah.
But every day that Wall Street is open and money is being traded, rates can fluctuate. So just because you see something on one day online in a marketing piece or on a TV ad or even a printed piece, that does not matter. Other than the one day it's posted, because it is changing constantly.
But as we've been speaking on the podcast, it's been the trending topic for I don't know how long. There's going to be days where rates are up. There's going to be days that rates are down, and it just depends on the economic information that's coming out that day. Right. So if you've been following Monday Mortgage Minute, or following us just in general, you know that these days are going to happen. Yep. This is something that's going to occur throughout the year, and until the Fed figures it out, economy gets back to what it should be, and until then, just expect the volatility.
Yeah.
Do we even think they're going to figure it out?
Well, we kind of alluded to that last week.
When they figure it out, if they do.
I'm going to hold my position again this week, second show in a row. They're kind of between a rock and a hard place, and I know we've been talking about this, but again, for those of you who might not have seen the show, the Fed is done out of one side of their mouth saying, hey, we're making progress in having some disinflationary pressure in certain segments of the economy, but not all of them. And then they're also saying, well, the longer that inflation persists, we're growing increasingly concerned that it will become entrenched, which is the opposite of disinflation. Mm-hmm. So I think that these next couple of weeks leading up between now and their March meeting, which is March 22nd, they're going to be really telling, because there's a lot of new information that's going to come out, but they have this like super long runway to kind of make their decision. And I think, I'm going to predict right now, I think they're going to still do another 0.25% increase, another 25 basis points in March.
So, absolutely.
I honestly agree as well, because I'm gonna relate it to horror films, right? So whenever the bad guy is chasing you, right?
I can't wait to hear this one.
Whenever the bad guy is chasing you, let's use Michael Myers as an example, right? Yeah. Everybody knows Michael Myers. I hope so. That's listening to this. But as he's chasing you, let's say they hit him once, they shoot him, and he falls down, right? And everybody's like, "Oh, we got him! He's dead! Finally!" Right? And then they go off like they don't even check if he's dead. They don't even secure that he's down. Like they just like, we did it. It's done. They go on with their day. Come to find out, as soon as they take 2 steps into like, moving from there, bam, Michael Myers is right there waiting for them. Bam. Inflation. And that's where I feel like we don't need to take our foot off the pedal right now, because though we have been seeing positive indicators that it is coming down at a slower pace, I don't believe we're still where we need to be near that 2% rate. That's the goal. No. So even if we are seeing, a better performance by the economy in the sense of inflation, I don't think we're nowhere near where we need to be, nor is it the time to slow down on that, because we see that unemployment's still not where it needs to be. People are still spending money, and that's still a huge factor on what inflation, is all about.
But think about how distorted that is. Like good jobs is wrecking their plan of bringing inflation down.
So it's like what's bad is good and what's good is bad.
Yeah. So that's exactly right. I mean, as long as we keep producing jobs, then we're going to continue to see rates continue to be hiked. So at the same time, they say that, will there be another rate hike? I really believe they will be, because supposedly the jobs market is that strong. Supposedly, right? And I mean, hey, who really knows?
So I got a good one for that one that I heard, right?
Yeah,
so,
you're totally alluding to something that came out right before this show, but go ahead, Brian.
So somebody put the creation of our jobs in a very good example, right?
Yeah.
So they used a husband and a wife, right? And they used the example of like, hey, you've been arguing with your wife, you guys decided to go to therapy and you guys decided to take some break, some time off, right? And, just to figure it out, see where you stand, see where she stands, and still married though, right? Still married.
Okay.
And, a month passes, you guys decide, hey, I figured it out, we figured it out, let's get back together. You go out to the party, you see your friends. Do you say to them, hey, meet my new wife?
Meet my new job.
Because what I'm saying is these are the people that were, from that were taking time off, that were, on unemployment, and now coming back to their regular job that they've been having.
Great point.
So does that mean that it was a new job, or was it just a job that was already held and now they're coming back to their position?
And further to Memo's point, that's attaching to that is the idea that the new way that they're counting job creation has just changed in January. They just talked about that right before this recording. So they just announced that they're changing the way they're measuring it, which is why the jobs looked so good in January, but it included seasonally adjusted jobs that are temporary for the shopping season.
That we can't really use.
So unless they remain consistent and those jobs are still available, or that means then they're not seasonal.
Yeah.
But if they are seasonal, that means that we should expect realistically a pretty steep drop off or a negative print of new jobs. And I am very curious to see what February.
Yeah, because I mean, when it's a seasonal, we can use that income when you're actually, approving a person for a home mortgage.
Right. Nope.
So why would we include something that we know it's only temporary?
Yeah.
Right. It's very difficult for any lender to trust the fact that they'll be able to pay for that mortgage on time because it is seasonal.
They're probably not going to be seasonal job the next season.
Correct. Yeah. It's very inconsistent.
And on the macro level, I'm hoping that the Fed will at least consider that as part of their decision making on whether or not they're going to do or not do rate hikes and how much and all that. Yeah. But it's like, man, this data, it's like every month or 2 months or 3 months, every quarter comes out and it's like, oh, they adjust this, they adjust that. Oh, whoops, we made a mistake here. It's like, dude, so you're making current policy decision based on data you believe to be true, only to find out down the road that it's not true.
Yeah, there you go.
That is real
I don't know what that's called. Manipulation? I don't know what that's called.
Shoot. But there goes the show. It's off the It's off the Bye-bye.
Yeah, here we go. But here's one thing that I know I didn't bring it up to you guys, but an assumable loan. I got an article on an assumable loan.
Yep.
Maybe that's going to be the next thing that levels up, and how is that going to play into the market? Because as we know, every loan is assumable out there.
Yeah.
VA, FHA, conventional, they have an assumable clause.
Right.
Where you could assume the same terms and conditions with interest rate, but it's very difficult. And when you go to the servicer, it can take them like 4 to 6 months for them to do anything. And supposedly you have to go back to the servicing because they don't have it dialed in right. And so basically what that is, if I'm looking to buy your home because you have a 2.25% interest rate, right? The house is for $500,000. The seller only owes $300,000. There's going to be a $200,000 deficit. So you have to get creative with that. Right. But those are the things that they're trying to figure out. How do we find a happy medium so that
Yeah, that's interesting.
it's pretty crazy. It was a cool article. I just thought I'd bring that up and see what your guys' take is on that.
We kind of talked about how the market's going to have to get more creative, and servicers specifically because they don't want to take back real estate, but they want to transact and even hold assets to continue collecting payments to pay their end investors. So I didn't hear about that. That's actually new to me, but I can see that being something that emerges more of a solution between two willing parties, like all real estate transactions are, two willing parties. But this is an alternative to maybe a more traditional a more traditional means that we're used to from a lending perspective. Yep. That's interesting.
You have to change, right? We all have to change the way the market takes us. Yeah. Either if we stay with it, we all may lose out. Yeah. Even home buyers, right? Sure. They may not be able to get in. But if we get creative and we become chameleons to the adapting market, right? Then we'll have to, that's why I think we'll entice more people to come in.
And one of the things I love about these opportunities is that it goes back to people, right? It's bargain and bartering and bargaining, right? So it's like, hey, you have a house. I need the house. I have cash. Right. Oh, you need cash. I need house. Let's transact.
Let's go.
Let's talk about this.
So I mean, people that have the upper hand in that negotiation, type of a skill, I think is going to be very valuable to have in your back pocket, right now, somebody that knows how to maneuver through those negotiations, just because of the fact that if the traditional route isn't going to be working, then you still need a house. You still need somewhere to live. How are you going to figure it out? And although banks are strict, there's still ways out there to figure it out as long as you have the right team and the right people advising you.
Well, that's right.
And remember, they're in the business of making money. The way banks make money is by issuing loans. That's how they make money. So they have to keep a product in the market. They have to have some sort of incentive and enticement for people to say yes to that. So they're going to get creative moving forward because they have to. Absolutely. Outside of that, they have all these other ways of making money. Yes, I know we're not going to talk about all that. But when it comes to lending specifically, that generates a rate of return. That's what they have to qualify people on, and that's the business they're in.
That's it.
So we're going to have to see some more stuff like this come to the market.
Yeah, it's an interesting market to say the least.
So I have a predictive question before we go on. What do you guys think needs to change in order for rates to stabilize or even return into the fours?
Me.
Me. I should only get a button. Ding it, like a Jeopardy button.
Andy, stop spending your money. Mr. Landeros, just like you said.
Stop lending it.
Okay? Stop spending. The more we continue to spend as a consumer, it gives a false interpretation to our federal government that we're okay. And that because interest rates are so high, we can continue to, spend with that. It's no big deal, right? Yeah. So for me, that's where it starts. People kind of start saving. Save better, because right now, as we all know, credit card debt has been off the roof. We're in historical debt, where clients are just using their credit cards for everything.
They're maxed to the hill.
As a matter of fact, there was actually another article that came out sometime last month where 35% of homeowners were having a difficult time paying their utility bill.
Yes. Wow. Yes.
So if we look at it like that, a lot of times, what do? You use that credit card.
Yep.
Okay. Yep. The credit card gets all that information, goes to the federal and say, oh, they're okay.
They can pay it.
They can pay it.
Good.
Well, and even on the utility front, that's something that like maybe 6 or 7 months ago, I mean, gosh, it's already February.
35.
They were talking about, I want to say it was August of 2022, maybe it was September.
Yeah.
But the headline was 20 million homes behind on at least one utility. And that was like 6, 7 months ago.
I don't think it's gotten any better.
Yeah. So I think the consumer spending is part of it because as long as we can keep showing we can keep up, we can keep keeping up. But until we can't keep up, we can't. Yeah. So I think that's part of it.
But the job market is strong, right?
The jobs is part of that.
And everybody can get a job, right? So,
I mean, jobs openings.
So that's why supposedly
that's what we speak.
Right. That's why we're saying, right? Supposedly the job market is that strong. We just saw, Zoom laying off 1,500 people.
Yeah.
That's where now. I don't understand what I don't.
After Amazon, after Google, after Microsoft, after Apple.
And we also got to keep in mind that this is fresh information that still hasn't impacted the people that got, let go of. Right. So once they then start capping out into their savings and credit cards because that paycheck isn't coming anymore, then those numbers are going to start showing up in the economy. And hopefully we'll start seeing, actual data of what's really coming out of all these, layoffs and people, losing their jobs, which will eventually trickle down into their pockets, the economy, they're not paying the bills.
Yeah.
And then it becomes like, well, which one is more important?
That's right.
So
that's right.
I want to give you guys my answer. I
Please.
think what's going to bring rates back
And
into
I agree with Will, by the way,
that
100%. Like, that's exactly what I was going to say. So, yeah.
So I want to tell you guys both. I think it's liquidity. I think new money coming to the market and having a larger basket of funds is what's going to bring rates down. Yeah. So just like the law of supply and demand, when there's more of something, it's cheaper to get.
Yeah.
So when there's more money into the market, no matter how it gets there, it has to come to the market, and that's what's going to drive rates down. It is a function of the bond market, yes, but also when there's more money coming into the market that can be lent out, that's when we're going to see rates go down, because that money is going to go chase after people who are looking for that.
I agree 100%. The other thing is we have to let the Fed know, stop spending the money.
Oh, yeah. God, as well.
Right?
Yeah. Follow your own advice.
It was a catch-22.
You see, it's like, and here's the thing, guys. What people don't understand, we got little Santi. Again, congratulations. You have your beautiful son, 1 year old. So here's the thing. The reason why we've been discussing a lot of generational wealth among our conversations now with our clients and teaching them that, to go in that direction is because we know what's going to happen.
Yeah.
We could already foresee what's going to happen.
Yep.
And unfortunately for you, I apologize to say it this way, but your son's going to one that's going to be paying for this.
Sure.
Yeah.
Yeah.
They're the ones going to be hurting, because when we're giving out trillions of dollars of taxpayers' money, the Fed's just giving it away like that. How in the heck are we ever going to get rid of our inflation? Stop spending, please.
That's why they hired 87,000 new IRS agents to go back.
So we're going to go there. We're just going to go, see?
Now our show's for sure gone, delisted from everything.
I'm sorry. Cut that.
Okay.
But that's the thing, right? We could go on, but those are the main things.
He started it.
People stop spending the money. Fed stop giving the money. We need more money to come in, for sure. Those are the things that the three things I think are major here.
Yeah. And I think that inventory plays a part of that. Available homes plays a part of that. People feeling the confidence and comfort to, sell their house and actually go on to the next one. I mean, that's one of the blocks I hear all the time. People, I don't want to sell my house because now I got to go find one and I can't even find one. So it's like this. Like this being, handcuffed to this desk and handcuffed to that. Like I can't make the move I want to make.
Highest equity ever, but I can't find crap.
I tell you. So I spoke with one of my friends who happens to live in Texas, right? And he's telling me, man, I read this article. You guys are hurting. Your values went down 30 to 40% in San Diego. And I'm like, what article are you reading?
What sources are you getting this from?
Luckily, I get my home bot. It tells me more or less where I'm at.
Yeah.
I mean, we've lost like 7-10%, right?
Yeah.
What I mentioned to him is, here's the thing. It's simple economics. Supply and demand.
Yeah.
Right? There's not a lot of supply for the demand of people that we want.
Yeah.
That are looking to buy a home.
Yep.
And then the way I put it is, if you go south from us, Mexico. Can't build over there.
Yeah.
Then if you go to the west, well, hey, we got our nice ocean, right?
Can't build there.
Can't build over there unless we're in Dubai and we're building in the water. You know what I mean? Maybe that'll get creative later. But and then you go to the west, we have our preserved mountains.
Yep.
They're preserved.
Yeah.
Like we can't build. So
we're
running.
landlocked. Yep.
Exactly. There you go. Going up.
Build up.
Up is your price of your home. Is that's the way if you buy it. That's where it's going.
North end altitude.
Yeah. So it's just, guys, it's just false.
Yeah.
It's just false. I mean,
you can't believe everything you read out there, and not everything is specific to us. It might be true for one neighborhood. That's not true for San Diego.
That's what I was saying.
Sure.
And I feel like you always been saying, Andy, like it's now more than ever more important to stick close to your lender and your realtor, because they know what's going on in your micro market, meaning that they are out there every day knowing what houses are for sale, what price range are they in, why are they dropping, who's coming up with the new listing. Like it's just like, I don't know why you would want to go to a generic pool of information where you're going to get just generic information. Do you feel like that's something you should be doing to yourself? Like, do you want generic information to make generic decisions for your life? Like, honestly, I don't know if you want that.
It's honestly the same reason I go to the mechanic.
Yeah.
I could do certain things on my car. I don't, because they work on cars every single day.
100%.
So when I don't know what that sound is or what that thing, I go to them because they know what to look for. They know what they're talking about.
When I record my videos, I go to Andy and Brian, I was just like, can I do them? Yeah, I can. But like,
you go to Andy and yourself?
Brian Chan, shout out.
Shout out to Chan, man.
Well, I stopped going to myself.
I was going to say, I go to Andy and then I don't. Yeah. Well, that's awesome, guys.
So, as we wrap up this episode, what other thoughts did you guys bring that you brought ready to share today that we maybe didn't touch on or I didn't ask about? What was something? Was there anything else you wanted to mention in this episode?
No. I mean, my biggest thing is prepare, right?
Yeah, 100%.
Always prepare.
Yeah.
Just prepare. Now, again, it was earlier we discussed the 3 Ps, right?
Yep.
which are
prepare, predict, persevere.
and persevere.
and persevere. There you go. So we already have the prediction what's going to happen, you know, and now all we can do is prepare so that we can persevere
through it.
Yeah,
you know what I mean? And so we're right there. That's the only thing.
Okay.
And, you know, pay attention to the people who are in the trenches right now, who have the resources to be able to provide this valuable information.
Great point. There are a lot of people who have retreated from this space as we're running like dead into it right now. So also take that word of caution / hint and straight up at you advice. We're here doing this, and a lot of people have retreated. I see a ton of people that we all know that ain't doing jack squat right now, not production wise, marketing wise, conversation wise, communicating what's happening with their perspective. Like they're either not taking the risk, they're not spending the money or the time, a combination of all that. So just I'll take my 2 cents for that.
No,
enjoy the ride.
For me is financial literacy has never been more important than right now, right? Understanding how money works as well, especially for the young generation. Like Will said, like, hey, we're going to be the ones that carry on, this, big mess moving into the generations to go. But it starts by you doing your part, by understanding how money works in your life, how it works in investments, how the money that comes in needs to stay in and not go out to Netflix, stuff that you don't need, and understanding like, what your real financial life looks like, what plans you have in 5 to 10 years, and then actually game plan strategically, clear, and with the intentions to actually make it happen when you put the timeline. So for me, it's like preparation.
That's great.
You know what you need to plan for, and then the perseverance is going to be in your execution and the people you surround yourself with. So make sure you have the right team, you make the right decisions, and you do the research and you take the time to understand how that information will affect you and not just the general public.
That's correct.
That's really good.
Correct. That's
really
great
good.
information, and you hit it right on, and I think people could appreciate that, and we just got to go with that and finish with that, because that was good. I think you put the nice cherry on the top already on that one.
Well, thank you guys again for an awesome conversation. Thank you for being willing to just come with it today and prepare, but also like give us your strong opinion and perspective, what you see and what we're looking at. Thank you guys, as always, for watching. So we appreciate you listening to the Mortgage Heroes Weekly Podcast.
Yes.
If you need help, you can reach us online at mortgageheroes.com, Facebook, Instagram, YouTube, email, phone, or text. Remember to share the show with the people you care about. We appreciate you, and we will see you again next week.